Hey everyone, welcome back to Corporate Decoder. Today, JAOVI Incorporated JAV just filed a registration statement, and I am seeing a ton of red flags that matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is offering shares at 3 cents a piece, and its entire business plan rests on one person. Alright, let's dive into this S-1 filing from Jaovi Inc. Basically, this is the document a company files when it wants to sell its stock to the public. It is like a roadmap of the company, its risks, and its plans. Jaovi is a Wyoming corporation, but their principal executive offices are all the way in Puerto Cortes de Osa, Punta Arenas, Costa Rica. That is quite a distance for a company that wants to be traded on us markets. They are offering up to 4 million shares at a rock bottom price of 3 cents each. They are aiming to sell these shares as quickly as possible once the registration statement is approved. Jaovi is checking the boxes for non-accelerated filer, smaller reporting company, and emerging growth company. This means they get to follow some less strict reporting rules, which is common for smaller companies. They are electing to not use the extended transition period for new accounting standards. This could mean they want to appear more mature or compliant, but for a company this small, it is a bit unusual. This is just standard legalese to allow the company to delay the effective date of the registration. So, the company is in the business of developing and operating a cloud-based project management software platform. They call it JAOVI. It sounds like a competitor to tools like Asana or Trello, but with some AI features built in. This is an initial public offering, meaning there is no existing public market for their stock right now. This is a huge risk for investors because there is no history to look at. Notice this, there is no minimum number of shares that must be sold for this offering to go through. This is a best efforts offering, which means they will try their best to sell the shares. But if they only sell a few, that is okay, they are not obligated to raise a specific amount. This is a big deal. The company is not using an underwriter like a big investment bank to sell its shares. Instead, their director Jorge Alberto Oviedo Mora will be selling them himself. This means he won't get a commission, but it also means there are fewer professionals involved in making sure the offering is properly managed and sold. If they sell all the shares, management will own about 20%. This is a significant stake, giving them quite a bit of control. They explicitly state they are a development stage company. This means they are basically still in the early phases of setting up their business and have not yet achieved significant operations or generated meaningful revenue. This is a crucial warning. Their stock will be classified as a penny stock. This means it is considered very risky, and there are special rules for brokers selling it to investors. It can make it very hard to buy and sell. The company's main office is in Costa Rica, and they have incurred losses since they started. They own software that cost them $52,000 paid in 4 installments. Their goal is to create a project management tool that uses artificial intelligence to help teams work better. They list out typical features you'd expect in project management software. They've paid for the software they are using. This is good as there is no outstanding debt related to its acquisition. Their plan is to make money through subscriptions and custom services. They're being upfront, there is no guarantee they will succeed. They officially started on the 21st of January 2026 and have done very little since. This is a very new company. Here are the financials. As of May 2026, they had only $1,100 in cash. They spent $3,500 on consulting and $31 on bank fees, resulting in a net loss of $3,531. This is a company with practically no operations. Mr. Oviedo Mora, the director, basically owns all the company's stock for a tiny amount of money, $200. This is how they started. This is a one-man show. Mr. Oviedo Mora is the only employee, officer, and director. This is a massive concentration of risk. If he leaves, the company likely folds. Again, no underwriter. He will try to sell the shares to friends, family, and business contacts. They are offering up to 4 million shares at 3 cents each, for up to a year, potentially longer. If they sell all the shares, the total number of shares will jump from 2 million to 6 million. Looking at the balance sheet as of May 2026, their total assets were barely over $53,000, but their liabilities were over $56,000. This means they had a stockholders deficit, essentially negative equity, of over $3,300. Remember, this is before any significant operations begin. The company has not generated any revenue and is completely reliant on getting more money. Their auditor has issued a going concern opinion, which means they have serious doubts about whether the company can stay in business for the next 12 months. They are admitting the investment is highly risky, and you could lose everything. If they don't get more money, they might have to shut down. Again, no guarantees they will ever make money. They are already losing money and expect to continue doing so. This is repeated because it's so important. The auditors are saying they might not make it. Think of companies like Bed Bath & Beyond or Tupperware that faced similar warnings before their struggles became extreme. Historically, about half of microcap companies with these warnings eventually go under. They acknowledge it is a very competitive market with big players like Asana, Monday.com, Trello, ClickUp, and Jira. They are much smaller with fewer resources. The tech industry moves fast, and they might not be able to keep up. They are not protecting their software with patents. This means competitors could easily copy what they do. Like any software, theirs could have bugs or go down. This can drive users away. People might just not use their product, even if it's good. With limited money, their marketing might not reach enough people to make them profitable. They are admitting they are still in the early stages and have a high chance of failing. If the plan doesn't work, the company could close down, and investors could lose all their money. Once you invest, you cannot get your money back. This is a very serious commitment. This is a critical risk. The whole company depends on Mr. Ovidio Mora. If he is gone, the company is likely finished. Since their main operations and director are in Costa Rica, it could be hard for us investors to sue them or enforce any legal judgments. Mr. Ovidio Mora only dedicates about 30 hours a week to JAOVI and has no experience running a public company. He is also involved in other jobs. This raises questions about his ability to handle everything. Because he is only part-time, things could move slowly and they might miss opportunities. Like any business, they could be impacted by things like pandemics. If they become a public company, they will have to follow strict rules like the Sarbanes-Oxley Act, which can be expensive and time-consuming. This is a big one again. Mr. Ovidio Mora's lack of public company experience could lead to compliance problems. Even after the offering, Mr. Ovidio Mora will hold significant power, potentially making decisions that do not benefit minority shareholders. Again, no underwriter means they might not be able to sell enough shares to even get the business off the ground. They mention a minimum of $30,000 in gross proceeds might be needed. Without it, they may have to seek other financing. Don't expect any dividends. You can only make money if the stock price goes up and you sell. No minimum means they might raise very little money, which might not be enough to achieve their goals. They want to trade on the OTC markets, but there is no guarantee they will be accepted. If they are, there's still no guarantee a market will develop. If Mr. Ovidio Mora decides to sell his shares in the future, it could drive the price down. Being an emerging growth company gives them some reporting leniency, but it can make investors a bit wary because there is less transparency. This penny stock classification is a recurring theme, highlighting the difficulty investors might face when trying to sell their shares. FINRA rules for penny stocks can make it hard for brokers to recommend or sell these shares, thus limiting buying and selling activity. They acknowledge that the penny stock market has a history of fraud, which could impact JAOVI stock if it gains any trading interest. This section is standard. It basically says that any statements about the future are just predictions and actual results could be very different. They are not promising anything. They are reiterating that there is no minimum for the offering to proceed. Here is how they plan to spend the money depending on how much they raise. If they raise the full $120,000 by selling all 4 million shares at $0.03 each, here is the breakdown. Public company reporting and regulatory compliance, $18,000. Software development and platform enhancements, $45,000. Marketing, promotion, and user acquisition, $35,000. Cloud hosting and platform infrastructure, $12,000. General and administrative expenses, $10,000. Mr. Ovidio Mora has indicated he might loan money to the company if needed to cover expenses and keep them reporting to the SEC. This is a lifeline, but it is not guaranteed. They admit the 3-cent price is arbitrary. It is not based on any real valuation, just what they think they need. This is a huge red flag. This is a critical part of the dilution section. As of May 2026, their net tangible book value was negative $55,331. This means they owe more than they own in tangible assets per share. That is about negative 2.7 cents. So new investors are buying shares at 3 cents, which is far above the company's current negative tangible book value. This means significant dilution for new investors. This section just reconfirms that their director is handling the sales. Mr. Ovidio Mora is using a special rule to sell the shares without being a registered broker. This is another sign that the company is trying to cut costs by avoiding professional help. The offering is open for a year with a possible 90-day extension. They have 75 million shares authorized, which means they can issue a lot more stock in the future. This can be a red flag for dilution if not managed carefully. The auditor is Alaba Awomolosim Partners based in Nigeria. It is unusual for a US-facing company to use an auditor from that far away. This can sometimes raise questions about the rigor of their audit. They were formed in January 2026 and are based in Wyoming, though operate from Costa Rica. They repeat that they are development stage and have no revenues. This is reiterating the negative equity we saw earlier. Their revenue model is primarily based on subscriptions. This is the location and date for the independent auditor's report. The auditors confirm they've reviewed the financial statements. This is the most important part of the auditor's report. They explicitly state that there is substantial doubt about the company's ability to continue as a going concern. This is the auditor's way of saying this company might not survive. They prepared the statements assuming the company will continue, but the doubt from the auditors is a huge warning sign. Here it is again, only $1,100 in cash. Their intangible assets, which is the software they bought, make up most of their assets. This shows a related party loan of over $52,000, which is likely from their director, Mr. Ovidio Mora, combined with accounts payable. Their total liabilities are over $56,000, leaving them with a negative equity of over $3,300. No revenue, they lost $3,531. The loss per S-share is practically zero, but that is because the number of shares outstanding is low and the loss is small. This just confirms the net loss and the resulting deficit in stockholders' equity. Their cash flow statement shows they spent $52,000 on the software and got $53,131 from related party loans and issuing stock. This brought their cash balance up to exactly $1,100. This is standard detail about what the company does. This is the second time the going concern issue is highlighted in the notes. It is a massive red flag. These are accounting rules they follow. Nothing too out of the ordinary here for a small startup. They are amortizing the $52,000 software cost over 5 years. This confirms the related party loan from Mr. Ovidio Mora. It is over $52,000 interest-free, and he can ask for it back anytime. This is a huge risk to the company's operations if he decides to call it back. This is the initial stock issuance to Mr. Ovidio Mora. He got 2 million shares for a mere $200. They have a small net operating loss carryover, but it is too small to make a difference and is fully offset by a valuation allowance, meaning they don't expect to be profitable enough to use it anytime soon. The costs to get this filing done are around $9,600. This is relatively low, but fitting for a company trying to keep costs down. This is the recap of the initial share issuance to Mr. Ovidio Mora, emphasizing it was done without a formal registration. This lists all the supporting documents. Nothing remarkable here. The filing is signed by Jorge Alberto Ovidio Mora himself as President, CEO, CFO, Secretary, Treasurer, Director, Principal Executive Officer, Principal Financial Officer, and Principal Accounting Officer. This one person holds all the key roles in the company, so... What is my take on JAOVI Incorporated? This filing screams high risk. They are a development stage company with no revenue, negative equity, a single point of failure in their director, a lack of patents, and a tiny cash balance. The fact that they are offering shares at 3 cents and are classified as a penny stock means any investment is extremely speculative. The auditor's going concern warning should give any potential investor serious pause. It feels like they are trying to raise money for basic operations and compliance rather than aggressive growth. The biggest risk I am watching is the overwhelming dependence on Mr. Ovidio Mora and whether he can actually execute this business plan or secure further funding. What I am actually looking for from a company like this is a clear path to revenue and profitability, which is currently absent. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.